This class will look at the topic of disinvestment and disinvestment strategies. Disinvestment, well, this involves liquidating some assets so as to reinvest the money in other and more profitable parts of the business. So it's looking critically at profitability of different parts of the business and then disposing of those parts which are not contributing significantly to the overall performance of the business. So it's readjusting the portfolio of assets. It's liquidating, disposing of the poorer performing assets and reinvesting the realized capital from the disposal of those assets, reinvesting that in the more successful parts of the business. With this strategy, resources are invested to rectify a problem and not for growth. So in this case, the business is looking at the performance of the business and trying to fix the problem of underperforming assets. So it's not really the intention of this strategy to generate growth. It is the intention to better utilize the asset base of the business. This could be to develop or enhance competitive advantage or support weaker areas of the business. So it's a total readjustment of the assets, looking at some assets which are underperforming, disposing of those and reinvesting the resources freed up by their disposal, reinvesting those resources in other more successful parts of the business. Disinvestment involves three strategies: retrenchment, turnaround and divestment. And we'll look at each of these in turn. Starting with disinvestment occurs when a company is overextended in a particular market. So a company may have too many resources committed to a particular market. So it wants to diversify a bit more. It wants to reallocate resources so as to diversify risk, for example. Perhaps opening a second line of production, a different product, opening a different market, diversifying just in case. Disinvestment could occur when it suffers economic reversals due to competitive pressures. Sometimes competitors can win out in strategic battles in the marketplace, so that companies have to reevaluate their position in the market, and perhaps if they're not doing well in a particular market, they wish to disinvest, take their assets out of that market. They don't see any long-term gain to be involved there, and they reinvest the capital realized in other assets which reorientates the business. In other words, there will be a shift in the strategic plan away from one market in favor of another market. It could be that the overall demand for the product simply declines. It's not necessarily down to competitive pressure, it's just simply consumers are moving away from the product and looking for some substitutes. This happens, for example, if there are lifestyle changes. It might be health warnings, or maybe certain products are seen as not fashionable or not desirable. So again, the business needs to get out of that line of production, needs to disinvest and reallocate its resources elsewhere. Strategic alternatives could result in lower costs or higher quality of resources. So it could be that by moving resources from one line of production into another, there's more effective cost control, perhaps better technology is employed, or perhaps it's easier to make, or it's capable of production at a lower cost for whatever reason. And it could be, of course, that also manifests itself in higher quality product and a better reputation in the marketplace. Now, as I said, there are three types. So let's look at the first type, retrenchment. Well, this occurs when a company experiences fluctuations in profits. This could be due to economic recession, production inefficiency, innovation by competitors. So retrenchment means cutting back, moving back from full-scale participation in the market, retreating from the market. Three factors could be considered to improve efficiency. First of all, cost reduction, redundancies, perhaps leasing assets as opposed to buying them, not replacing machinery as it wears out. It's a type of retrenchment, just trying to make do without that machinery, finding ways to reduce expenditure. So these cost reduction methods are forms of retrenchment, moving back from the market, not full commitment, I should say, to the market, moving backwards from the market. It could be asset reduction, selling assets that are no longer required by the company. Perhaps it owns excess amount of floor space. It has premises to rent or whatever. Perhaps sell the premises or part of the premises. Perhaps it's got some land associated with the premises. Sell off the land for building purposes. So retrenchment means looking critically at its overall asset structure and seeing what can be disposed of. And that's a form of retrenchment. Revenue generation. Looking at the accounts and seeing what improvements can be made to accounting practices. For example, paying debts, paying off bills, perhaps delaying the payment of bills until they are absolutely due at the end of the month. Instead of paying them after 3 weeks, pay them at the end of 4 weeks. It improves cash flow. And change the stock turnover ratios. Try to minimize on stock and find alternative sources of stock for raw materials or work in progress or semi-finished goods. Try to find alternative sources so that the company doesn't have to hold large amounts of stock. Money in stock is tied up. It's not doing anything else. It's sitting in stock. If it was sitting in the bank, it may be earning a rate of interest. So looking at the business critically. And these are all forms of retrenchment policies. Types of disinvestment. Next one is turnaround strategies. Consider the development of new strategic position for a product or service. Look at the strategic position of the product or the service and consider new options, consider new ways of delivering the product. Perhaps look at the market it's targeting and see if other markets could be brought in earlier. Trying to find ways in which the product could be delivered in alternative markets simultaneously. Could it be launched in 2 markets as opposed to 1? What are the issues in bringing the product to market? It's the turnaround is the next step from retrenchment. Retrenchment, I suppose, would be the first port of call, trying to optimize on the use of assets. Turnaround would be the next step. Develop new and innovative ideas. It may be slightly long run, but turning around the business is looking at the product and looking at variations in the product which would be more acceptable in the marketplace. Looking at what the consumer wants and what can be done with the product to better meet customer needs. Revenue generating strategies are particularly helpful in this area, such as product modification, effective advertising, methods of lowering prices, and providing quality products or services. So turnaround is aimed at keeping the business going, but better meeting customer needs and expectations. So it's modifying the product, it's better marketing, more effective advertising, positioning the product in the market with a higher profile, branding the product, lowering its price, and so on. And these are all types of turnaround strategies that may be deployed in order to help the business in times when it may be facing financial issues. Now, divestment. This is if retrenchment or turnaround fails, another alternative could be to sell a part of a business unit or a subsidiary. This is much more dramatic. It's if the retrenchment and turnaround strategies fail, then the business may look at this as a last ditch solution. The organization is aiming to create an effective portfolio of products and services. That's what organizations try to do. They try to balance their portfolio of products and services. One problem associated with divestment is finding a suitable buyer if the company is in difficulty. Now, divestment may mean selling part of the business. It may mean looking for new sources of finance which will enable it to generate new products and enter new markets and innovate and buy in more cost-effective machinery and so on. But in order to find the investors, it has to divest, it has to change the business. Some people will have to step aside perhaps and let new people into the business. Or it may be simply looking at parts of the business and selling them off completely to other companies, perhaps unrelated companies, perhaps selling land, as I said earlier, or selling part of the premises, or instead of buying the capital, trying to lease the capital. But it's divestment. Divestment occurs when a company may need to raise finance in a short space of time. It really is a type of emergency response. It's considered when there are mismatches evident between the parent company and a subsidiary company. That's when divestment normally takes place. If there's a company that has a subsidiary, but they're not fitted, they don't really go together. There's not room for much synergy between them, then there may be divestment. The company may sell off the subsidiary and get out of that line of production. So we have the three approaches: retrenchment, turnaround, and divestment, all trying to slim down the business and perhaps turn around the business and address issues. There's also the possibility of liquidation. This involves the sale of a whole business. This means selling the whole business. Unpopular choice, that's seen as a failure by the management team. Liquidation is when there is no hope. It means closing the business, liquidating the assets, selling off the assets, or trying to find a buyer for the business. It may prove to be in the best interest of stakeholders from a long-term perspective. Although closing a business is normally a very painful exercise. workers are made redundant, they lose their incomes, they lose their jobs, families are affected, the local community is affected. Not just the shareholders, it's a widespread issue that affects all of the business. It's important that organisations change and improve their strategies occasionally and are able to accommodate to changing situations. Now this should avoid failure, but sometimes the strategies may be wrong. Management may believe they are correct at the time, but circumstances catches up with the business, the product is seen as old-fashioned, it's not competitive, new markets overseas arise, imports flood the market, the company may come under pressure for a variety of reasons, and this could lead to liquidation, selling off the business entirely, closing the business, disposing of its assets. Unfortunately, in times of recession in the economy, this is quite commonplace. So, quite a depressing topic. What we've talked about here is the strategy of disinvestment, reducing the size of the business, cutting off parts of it, and ultimately closing the whole business itself. So that concludes this topic on disinvestment. Let's leave it at that and simply say thank you for watching.